Investing is a path filled with potential rewards and risks, and even the most seasoned investors can fall into certain traps. According to Warren Buffett, one of the greatest investors of all time, there are 12 common mistakes that almost every investor makes. In this video, we'll dive into these errors and explore how avoiding them can help you achieve greater success in your investment journey. Number 1. Timing the market. One of the biggest mistakes investors make is trying to predict market movements. Many are tempted to buy when prices are low and sell when they're high, believing they can outsmart the market. However, Buffett emphasizes that even legendary investors, like his mentor, Benjamin Graham, made the mistake of attempting to predict the market. Instead of focusing on short-term fluctuations, Buffett advises looking at individual businesses and their long-term potential. The future direction of the market is important, but it's not knowable. Trying to predict macroeconomic events is risky, while identifying solid companies with strong fundamentals is a much safer bet for long-term success. As markets become more volatile and influenced by unpredictable global events, attempting to time the market will become even riskier. In the future, investors may rely more on technology, such as AI, for data-driven insights. But predicting short-term market movements will remain elusive. The focus will likely shift further toward long-term strategies, where identifying companies with strong fundamentals and sustainable growth becomes the key to success. As macroeconomic uncertainty grows, patient, value-oriented investing is expected to dominate over short-term speculative bets. Number 2. Getting attached to your purchase price. Many investors become emotionally attached to the price they paid for a stock. If a stock declines after purchase, they may hold on to it, hoping to break even. Conversely, if the stock rises, they might feel proud of their decision and rush to lock in profits. However, Buffett reminds us that the purchase price is irrelevant to the stock's future performance. The only thing that matters is the company's future potential. Decisions to hold or sell should be based on the company's prospects, not the price at which it was bought. As more investors turn to automated trading platforms and AI-driven tools, emotional biases like attachment to purchase prices may lessen. Algorithms could assist investors in making data-driven decisions, emphasizing company fundamentals over emotional attachment to entry points. This trend could lead to more rational investing, where the focus is solely on long-term growth rather than short-term price movements. Number 3. Aggressive growth projections. Another common mistake is assuming that companies will maintain rapid growth indefinitely. High-growth companies often promise future returns, but very few can consistently grow earnings at rates like 15% annually. Buffett warns that expecting high growth rates is a trap, especially when purchasing stocks with high price-to-earnings (PE) ratios. While growth is important, assuming continuous, aggressive growth can lead to overpaying for stocks. Investors should be cautious and focus on realistic growth expectations. Investors may become more cautious about aggressive growth projections, especially as global economic conditions fluctuate. In the future, we might see a stronger emphasis on companies with sustainable, steady growth rather than those driven by short-term hype. With the help of AI and advanced analytics, investors could better assess a company's realistic growth potential, leading to more balanced portfolios and reduced exposure to overvalued stocks. This shift could create a more stable investment landscape, favoring fundamentals over speculative growth. Number 4. Using a lot of leverage. Leverage can amplify gains, but it also magnifies losses, and Buffett believes that relying heavily on borrowed money is dangerous. Leverage can put investors in situations where they're forced to sell at the worst possible moment, even if their original investment thesis was correct. This is particularly true during financial crises when lenders may call in loans, forcing sales at low prices. Avoiding leverage can help protect against catastrophic losses during market downturns. The risks associated with high leverage may increase. With stricter regulations and greater access to risk management tools, investors could begin to favor more conservative strategies. Additionally, AI-driven platforms may assist in identifying leverage risks earlier, helping investors reduce their exposure and avoid forced liquidations. This trend could lead to a more risk-averse investment environment where caution outweighs the potential for amplified gains through borrowed money. Number 5. Missing the forest for the trees. Investors often get bogged down in the details, focusing on specific contracts, patents, or short-term issues instead of the bigger picture. Buffett emphasizes the importance of focusing on the three things that matter most: the future economics of the business, the quality of management, and the price paid for the company. If these factors are sound, minor details are unlikely to derail the investment. Focusing too much on individual components of a business can distract from the overall value of the company. Investors might face a flood of detailed information that could lead to overanalysis. However, these same technologies could also help investors streamline data and keep their focus on the most important aspects, such as long-term growth, management effectiveness, and overall business strategy. This shift could allow investors to strike a better balance between detail-oriented research and maintaining a broader, strategic perspective. In the future, the ability to sift through vast amounts of data without losing sight of the big picture will likely become a critical skill for successful investing. Number 6, jumping over 7-foot bars. Some investors believe that solving complex problems or tackling difficult investments will lead to better rewards. However, Buffett prefers to focus on simpler opportunities, those he can understand easily and where the probability of success is higher. This mistake stems from the notion that more challenging problems yield better returns. But in investing, straightforward solutions often lead to greater success. Technology and data become more advanced. Investors may feel tempted to dive into increasingly complex strategies, assuming they'll yield higher returns. However, simplicity may remain a key to success, especially as AI and algorithms make it easier to identify and capitalize on straightforward opportunities. In the future, we could see a resurgence of value-driven investing, where simplicity and clarity in understanding business fundamentals outweigh complex strategies, resulting in consistent, long-term success. Number 7, shrinking your universe of opportunities. Restricting your investments to a specific sector, industry, or niche can limit your potential returns. Buffett encourages keeping an open mind and not narrowing the universe of opportunities. Markets shift, and new opportunities often arise in unexpected places. Limiting investments to just one sector, whether it be tech, ESG, or high-dividend stocks, can cause investors to miss out on promising opportunities elsewhere. Investors who remain too focused on one sector may miss the next wave of innovation or growth. In the future, investors may increasingly use AI and data analytics to uncover emerging trends across a wider range of sectors. By diversifying across industries and being open to new opportunities, investors could position themselves to capitalize on unexpected growth areas such as sustainable energy, biotech, or even new technologies not yet on the radar. This broader approach will likely help mitigate risk and increase potential for higher returns. Number 8, staying active. All the time. One of the most counterintuitive lessons in investing is that inaction can sometimes be more rewarding than action. Investors often feel the need to be constantly trading, but Buffett advises against this. There will be periods when opportunities are scarce, and trying to force trades in these times can lead to poor decisions. Instead, wait for the fat pitch, the right investment opportunity that fits within your circle of competence. The temptation to trade frequently will continue to grow, especially with the rise of algorithmic trading. However, in the future, successful investors may increasingly adopt a more patient, disciplined approach, waiting for clear, high-quality opportunities rather than chasing constant activity. AI could further assist by identifying the best fat pitch moments, helping investors avoid unnecessary trades and focus on long-term gains. Number 9, diversifying too much. Buffett is famously against excessive diversification. While diversification can help protect against risks, it can also dilute potential returns. If you've identified 6 strong businesses, that might be all you need. Adding more stocks for the sake of diversification can reduce your overall returns. For investors who are knowledgeable about their holdings, focusing on fewer, high-quality investments can yield better results than spreading capital too thin. In the future, investors may increasingly lean toward concentrated portfolios, focusing on fewer, high-quality stocks. AI and machine learning could help identify strong businesses with greater precision, allowing investors to focus their resources more effectively. This approach, combined with greater confidence in understanding business fundamentals, could lead to a reduced emphasis on broad diversification, with more investors betting on their best ideas for higher returns. Number 10, confirmation bias. Humans have a tendency to interpret new information in ways that reinforce their existing beliefs. This is known as confirmation bias, and it's a major pitfall in investing. Buffett acknowledges that even he and his partner, Charlie Munger, have made mistakes by failing to reassess their positions objectively. To counteract this, Buffett recommends regularly reevaluating your portfolio and being open to changing your views when new information arises. AI and advanced analytics could help investors overcome confirmation bias by providing unbiased data and insights. These tools may offer investors clearer signals when it's time to reassess or adjust their portfolios based on changing market conditions or new information. As technology improves, more investors may rely on objective, data-driven analyses to counter personal biases and make more rational investment decisions. Number 11, following the herd. Investing based on popular opinion can lead to disaster. Markets often swing between extremes of fear and greed, and following the crowd at these moments can lead to buying high and selling low. Buffett and Munger have always been contrarian investors, focusing on the intrinsic value of businesses rather than market sentiment. They believe that going against the grain, buying when others are fearful and selling when others are greedy, is where real value is found. In the future, with the rise of social media and real-time market data, herd mentality in investing could become even more prevalent, leading to market volatility driven by popular trends. However, investors who leverage AI and data analytics to assess intrinsic value may have a distinct advantage. As more market participants rely on hype or popular sentiment, those who maintain a contrarian approach focused on value investing could continue to reap greater rewards by capitalizing on mispriced assets and market overreactions. Number 12. Mistakes of omission. Sometimes the biggest mistake is not taking action. Buffett has often lamented missed opportunities that were within his circle of competence, but where he hesitated or didn't act decisively. These mistakes of omission can cost billions in lost potential profits. If you've identified a great investment, don't let fear or indecision prevent you from taking action. As access to information and real-time data improves, the fear of missing out, FOMO, might increase, leading to more impulsive investments. However, savvy investors may adopt tools like AI to help assess opportunities faster and more confidently, reducing the likelihood of inaction. In a fast-paced future, the ability to make timely, well-informed decisions could become a competitive edge, helping investors avoid costly mistakes of omission. Avoiding these 12 common investment mistakes can drastically improve your chances of long-term success. As Buffett reminds us, focusing on what's important and knowable, avoiding emotional attachments, and being patient are key principles of smart investing. By learning from these lessons, you can make more informed decisions, avoid pitfalls, and ultimately achieve greater financial success through the stock market. If you enjoyed this, don't forget to like, comment, and subscribe. Your support means the world, and it helps us keep bringing you more great content. Plus, I'd love to hear your thoughts. Drop a comment below.